All right. Hey guys, I wanted to post a video for chapter 15. I wanted to go over two problems with you. One, a general job costing problem, and the other one having to do with calculating the predetermined overhead rate. So the problem I picked out for the job costing was problem 15-2A. It's on page 599 in your textbook. And this is the situation or the scenario that they set up is that they provided you with a trial balance for this company, and that as the trial balance was being reviewed, there were some problems with it. One of them is that there's no wages payable on here. There's no wages payable account on here, and so there's a bit of a problem. So the manager notices a few issues, and so they do some troubleshooting. And on the flip side page, they identify what some of these problems are. Essentially, there are some items that did not get recorded properly. And so they want you to basically go through and fix the issues, is what they want. And so what you end up having to work through, and what I show you, is I go through requirement 1, requirement 2, and requirement 3. I kind of leave requirement 4 up to you guys, the financial statements. I think you guys should be able to put together an income statement and a balance sheet. Given a trial balance, that's something you should have gotten out of Principles of Accounting 1. So I would definitely do that as practice for yourself. And then 5 is an analysis question where they throw a little curveball at you and say, well, what if? What if this should have happened instead of this? And so you have to do a little bit of analysis and thinking. And so that part of the problem is really important, because you really do need to be able to think through these things and understand how a change in one thing can affect other things within the financial statement structure. And so this one change, which was a misclassification of an item, what impact it has on the balance sheet and what impact does it have on the income statement. Now, they specifically ask about balance sheet accounts, but you need to be able to think about it in the broader perspective of, because they could have just as easily asked you about what impact it had on the income statement. So you should be able to kind of recognize the full impact of a particular misclassification on the financial statements as a whole. And so that was the problem I wrote up and I posted online. It's not a video recording, it's just something that I worked up and posted, but I did want to talk about it for a minute. Now, the other problem I wanted to go over is this one here, and this is on calculating a predetermined overhead rate. Now, let me hit the autofocus adjustment here, see if we can't get that a little clearer. Yeah, okay. At least it's clear on my screen. This is problem 15-4A. It's overhead allocation and adjustment using a predetermined overhead rate. Now, the fact that they call it a predetermined overhead rate means that it's being determined up front before you have actuals. Okay, so that means somebody, a manager, management team, whatever, is preparing some kind of estimate. And so with an overhead rate, this is a single overhead rate that's going to be applied to different jobs. Now, again, what you should get out of chapter 15 is that this job costing that they're talking about, which is it's for specialized products, things that are differentiated one from another, so that two different products could be working through the manufacturing process, through the assembly process, and they could be quite different from one another. An example of this would be in shipbuilding. Shipbuilding, they build to customer specifications, and so they tend to use a job costing rather than a process costing or an activity-based costing. Airplanes, probably large jetliners, may be more appropriately costed using a job costing as opposed to a process or activity based costing. Another one could be custom homes. uh, and remember, there's no hard and fast rule here. you can have mixed systems where they use elements of job costing and elements of process costing or elements of activity-based costing. And of course, after chapter 15, 16, and 17, 16 will go over process costing and 17 will look at activity-based costing. So with job costing, a product will say, hey, okay, let's look at a yacht, a boat. And so they're building these large yachts for individuals. They're custom built, ordered from the company. And so what they have is, you've got all of the materials that go into the manufacturing of the boat. And then, of course, the labor, okay, to actually build the boat. And so there's a bunch of these direct costs that you can directly trace to that individual boat, which we call an object. That's our cost object. That's the thing that the costs are attaching to. So that boat that's being built is using that material and using up that labor. But in addition to that, there's a bunch of these other costs that have to be accounted for, costs that aren't directly associated to the boat. They're indirectly associated. They're things that are necessary to the manufacture of the boat, but they don't have a direct tie to the actual boat itself. And so we allocate those costs using some kind of an allocation rate. Okay, and that's what we're calculating here, is that allocation rate for those indirect or overhead costs. So in this particular problem, what they tell you is that the manager has estimated what the total direct labor cost is, employing 50 persons at an average of $2,000 at an average wage rate of $25 per hour. So that's what they're saying they're going to be incurring over the course of the year. And then they estimated their overhead costs, their manufacturing costs, and so that's what this table is here. And so they're estimating $1.5 million in overhead costs, and that's going to be applied using, and they'll tell you right here, says the company's predetermined overhead rate is based on direct labor cost. It can also be based on other things. It can be based on direct labor hours. It can be based on machine hours. There's a couple of different bases that they can use to allocate over. It just depends on the manufacturing process. And so, what is the cost? What is the labor cost? Well, it'd be the 50 persons, right? You'd have 50 enter times 2,000 hours, okay? And so that's 100,000 hours, all right? And it's times $25 an hour, so enter $25 an hour times, so it's $2.5 million in direct labor cost. So that's what they're estimating is the direct labor cost. So with that in mind, I'm going to take the $1,500,000 in estimated overhead costs, and then I'm going to divide that by the estimated direct labor cost. And what I get is 60 cents per hour. So it's 0.6. So essentially you could look at this as 60% of direct labor costs. So what that would mean is if they spent $100 on direct labor, there would be an additional $60 of indirect cost allocated to that particular job. Okay, so that's what that means. And that is basically requirement 1, part A, is what is the predetermined overhead rate for the year. And so that would be the predetermined overhead rate would be that 60%. Then they want to know what total overhead costs apply to each of the 6 jobs. They list 6 jobs in this paragraph here, and they give you the direct labor costs for each of the jobs. And so what you want to be able to do is allocate the overhead costs to each one of those jobs. So you're going to be applying this. First, you calculated it. You're going to actually incur indirect or overhead costs over the course of the year. So you had your estimate up front. You'll have your actuals by the end of the year. But in the meantime, you still have to allocate costs. So, and that's going to result in kind of an issue, and we'll talk about that in a second. So let's see, job 201, $604,000 in direct labor costs. 600 and let's see, $4,000 in direct labor costs for this particular job. And so I hit enter. This is my HP 12C, so it works a little differently than a regular calculator. It starts to work more like it's actually a mini computer is what it is. It's been around a long time. It's a financial calculator by Hewlett Packard. It's a really nice. It's a nice calculator to have. It's expensive. It's programmable. Has a lot of memory slots in it. So, but anyway, and we calculated that the overhead rate was 0.60. So we've hit enter, and then we have 0.60 times. And so that would mean that the overhead being applied to this particular job would be $362,400. And so you basically would go through each one of these jobs, and there are 6 different jobs, and you would calculate how much overhead would be applied to each one of these jobs. That would give you the total overhead cost applied to each of the 6 jobs during the year. You would list each of those numbers, and then you'd be able to total those, and that would give you the total amount of overhead costs applied across all the jobs. And then 1C says they want to know what the over or under applied overhead at the year end. And this is the problem I alluded to a little earlier. When you're basing something on an estimate and then you actually incur actuals over the course of the year, how well you estimate, are you going to be able to estimate to the penny? No, probably not. And so what you estimated up front is going to be a little different than what you actually experience over the course of the year. And so when you use that predetermined overhead rate and then you compare what the total amount that you applied versus the total amount that you incurred, there's likely going to be a difference. And either the incurred is going to be higher than the applied. Okay, if the incurred cost is higher than the applied cost, then you have underapplied overhead. If the applied is higher than the incurred, then you have the opposite. You have over applied. Okay, so that means you've allocated too much. And if it's not a material amount, if the amount's not material, what you can do is you can take that underapplied or overapplied and you can actually close it out against cost of goods sold. If the amount was considered material, there's a different way to close it out. You would actually have to allocate it over the different inventories, not just the cost of goods sold, but you'd have to put some of it into the finished goods as well, and possibly into the work in process. And so there'd be kind of a ratio you'd set up, and then you would apply it to each one of the inventories that's there. Again, that's if it's material. I think a lot of the problems end up assuming that it is not material and they just close it out to cost of goods sold. The problem will always tell you which method to use. The book does teach you both methods. Now, at this point, you should stop the video and you should try to work through this problem and see what you can come up with. And then when you return, we will actually go over the problem together. And so you'll be able to check your answer against mine. Okay? Okay, hopefully you've taken some time and tried to work on this problem. And so what we end up with here is, again, just by way of review, we were asked to determine or calculate the predetermined overhead rate for the year. They gave us the estimate for direct labor cost, and they gave us all of the estimated overhead costs, and that's what you're going to need because we're being told that the company's predetermined overhead rate is based on direct labor cost. And so, and that's, let me slide that down there so you can see that. So that's the line right here. That's why you got to be reading these problems carefully. And then we have to take that rate and apply it to the different jobs, and they've got 6 different jobs, 5 of them completed, 1 of them is in process, and so we apply that rate to the direct labor costs for each of those jobs, determine what we're going to apply, and then at the end of the year we'll know what our actual overhead costs were. We compare the actual to the applied and determine whether it was over applied or under applied, and then we have to do part C or part 2 or requirement 2, and we have to close out that amount. We have to zero out the overhead account. And so this was the solution that I came up with. So first, our overhead rate is 60%. 0.6 or 60%, and it is the direct labor cost was the estimated direct labor cost is 50 people times 2,000 hours per times $25 per hour, which is 2.5 million. That gets divided into the $1.5 million estimated overhead costs. And then we apply that to each of the jobs. These are the direct labor costs for each of the jobs, and then we multiply it times the rate, and this is the amount of applied overhead costs for each one of these jobs. You total that number, you take the actual overhead that's given in the problem. Again, where did they give it to us? It's this is an area where I find a lot of students ask questions, ask where this stuff comes from, and I always tell them you got to read the problem and pull all that information out. And so here's where they gave us what the actual. So they say at year end, records show the company incurred $1.52 million of actual overhead costs. Okay, and so then we can go ahead and calculate whether, so in this case, the applied overhead is less than the actual, so that means it's under applied, and it's by $12,800. And if you have your debits and your credits straight, or your left and right side of the T account, the actual overhead is going to be on the left side, the debit column, and the applied is going to be on the right side or the credit side of the T account. So that means that the credit side is lower than the debit side. So that means we're going to have to credit the factory overhead account. And so when we make the adjusting entry, assuming, again, they tell us in requirement 2, they say assuming that it's not material. So once they tell us it's not material, then we know we're just going to close it out to cost of goods sold. And so we debit cost of goods sold, $12,800, and credit factory overhead, $12,800. And what that does is that closes out the account. And if you look at it from the T account perspective, so if I write factory overhead, okay, again, the actual numbers come in over here. The applied is over here. Okay, and so we know we're at a balance, right? Because we've got to strike a balance, and so we don't have enough. And so what we do is we take that 12,800 here, and then that gets us to a zero balance. Okay, that gets us to a zero balance. So that's in essence what the T account ends up looking like. Okay, so again, this is a fairly straightforward example of applying a single overhead rate. What we'll find out as we move through each of these chapters, the next couple of chapters, is that the overhead question can become more complicated because you can have more than one overhead account. This is just one single company-wide overhead number, you can start having multiples, and we'll see that situation arise and have to deal with that. But this is a good place to start in terms of trying to understand the overhead. And remember, all of this is again, when you think about total manufacturing costs, you're thinking about direct labor plus direct materials plus factory overhead. That gets you your total manufacturing cost. And so what we've been working with here is that factory overhead portion. And we based the amount of applied factory overhead, the amount that we were going to apply or allocate to the different jobs, we based that on an estimate that's created at the beginning of the year. So again, at the beginning of the year, when you're working these problems, you're always going to be saying, okay, if it's a predetermined overhead rate, that means it's an estimate. So I need to be looking for the estimated numbers. Okay, you don't use actuals to calculate the overhead rate. You use the estimates for the predetermined overhead rate. You apply it against actual numbers. So these are the actual direct labor costs that are charged to these 6 jobs. And so you apply that predetermined rate against those actual labor costs, direct labor costs, to come up with the applied overhead. And this applied overhead is then compared to the actual overhead to determine whether it's underapplied or overapplied. If it's deemed not material, which in this case it is, then it's going to be closed out against the cost of goods sold. And so in this case, it increases cost of goods sold, decreases the factory overhead account so that it balances out to zero. Okay, so it closes it out. All right, so that gives us 2 problems from chapter 15 that I've kind of worked out with you guys. And so I'll be doing the same thing for 16 and 17. Again, if you have any questions, please make sure that you email me, and I will try to do my best to answer them and work hard on the homework problems. And I hope that you're enjoying this. This can be a lot of fun. Cost accounting, managerial accounting can actually be the fun kind of accounting. Not quite as dry maybe as financial accounting, because you're really tied into the heart of a company. If you like being in the details and you really like being on the inside and working alongside management, and this is a great place to kind of plant yourself and develop a career. You can have a solid career. There's a certification called the Certified Management Accountant, CMA. It's through the Institute of Management Accountants. It's a solid professional organization with a solid certification that is respected within industry. And so you can be an internal management accountant, leading to a career as in accounting management. Uh, Again, it's going to be a mix of both financial accounting and managerial accounting, but some people really like that managerial accounting a lot. And so it's pretty interesting. And of course, if you're an accounting major, if you become an accounting major, you'll take a cost accounting class in addition to the principles class that you're taking now. And if you're not an accounting major, regardless, if you're marketing, it's important to understand costs when it comes to marketing, because you're negotiating contracts, we're negotiating pricing. How do you negotiate pricing without understanding the cost of something? If you're in logistics and supply chain, again, uh, all those overhead costs that play into the logistics and supply chain process, and even the direct materials costs coming in. There's a lot of issues where it's helpful to understand the internal accounting behind this. If you're into purchasing and procurement, it becomes really important. So there's lots of places where this kind of plays in. If you're in the production line, if you happen to be a manager or supervisor in a production area, you're going to be managing both the direct and the indirect side of things, because you're having to make sure that there isn't a lot of waste going on, that people are working as efficiently as possible, so that this way, you're not having a lot of downtime. So there's lots of neat things going on in the managerial side of the house that can be applied to all the different business disciplines. So at any rate, hopefully you guys enjoy that, and I'll be talking with you again soon.